Corporate finance practice problem using OneNote. Capital lease versus operating lease balance sheet impact. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab down in the 1631 Capital Lease versus Operating Lease Balance Sheet Impacts tab. Also note, when using OneNote, look at the Immersive Reader tool. Our practice problems will be down in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top. We're going to go through the calculations then on down below. We're going to have our balance sheet. This is our starting point balance sheet. And then we're going to consider the difference that would happen if a lease that currently is not on the balance sheet, presumably it being thought to be an operating lease because it's not on the balance sheet, is then determined to be a capital lease and therefore should be on the balance sheet. We'll add it there and see what the difference to the balance sheet would then be. So we got a basic kind of balance sheet starting point. We'll say the current assets are at the $70,000, PP&E, property, plant, and equipment, $55,000. Total assets then at the $125,000. Liability side of things, we got the current liabilities, $11,000. Long-term liabilities, $42,000. Total liabilities, $53,000. Equity then at $72,000, the total liabilities and equity being the same as the assets, of course. That's why it's a balance sheet at the $125,000. Then we're going to say that there are leases that were determined to be capital leases, and they have annual payments that are at the $28,000, discount rate 30% over 30 years. So now we got to say, okay, these leases then, we got to put them on the books. We got to put them on the books, kind of like we had the asset on the books. And then we financed it. So we got the asset and the loan that's in both sides going to have to go on the books. So to do that, we'll say let's present value then the lease payments to see what that would look like. So we have nice annual payments here and a discount rate 30 years. So if we were to take the present value of that, it would be the negative present value of the rate 13%, comma, number of periods going to be 30 years, comma, the payment being the $28,000, giving us a present value then of those payments at the $209,878. So we're going to basically assume that the asset has a value then of the $209,878, and that we financed it basically for a liability of the $209,878 in essence. So what would that look like if we put it on the balance sheet? We're going to say, all right, well then let's check it out and see. That's why we're here. That's what we're doing. So the balance sheet would look, we'd have the $70,000 still. Saying we're comparing and contrasting, you see. This is where we were before. This is where we're at now. $70,000 current assets, property, plant, and equipment still at the $55,000, and then we're adding the leased property under the capital lease. So that's going to be the asset $209,878. The 70 plus the 55 plus the $209,878 gives us the total assets of the $334,878. On the liability side of things, we still have that $11,000 of the current liabilities, same as before. Long-term liabilities still at the $42,000, but now we have the obligation that we're assuming at the same $202,878. Adding up the $11,000, the $42,000 to $209,878, we get to a total liability of the $262,878. That gives us the equity of the $72,000. We can calculate that by saying, well, we now have the assets, the $334,878 minus the $262,878 liabilities, $72,000 on the equity, giving us the liabilities plus equity, which will be the $262,878 plus the $72,000 of the $334,878. That, of course, matching the total assets, making our balance sheet balance, which is good. We like that. So that means that, notice the equity is the same here. No change to the equity. So the first thought of this is like, well, what the bottom line, basically net assets minus liabilities, or in other words, the equity hasn't changed. What's the big deal? And that is the case, but of course, some other ratios will be impacted. So for example, key ratios that could be impacted by this would be the debt to asset ratio. So if we looked at the debt to asset ratio, we would simply be comparing the debt to the assets. If we look at the before numbers, before we had the debt, which was only at the $53,000, compared to the assets which were at the 125,000. If we did the ratio calculation, pulling out the trusty calculator, 53,000 divided by the 125,000, we get to the 42.4%. And the after situation, we have the 262,878 debt, 262,878 versus the assets, which are now at the 334,878. So if we do that ratio analysis, analyzing the ratio 262,878 divided by 334,878, we get to the 78.5% about. So substantial difference in the debt to asset ratio, which could have impact on decision-making processes. If we look at the debt to equity ratio, this will have a substantial impact as well. Before, we had the debt was at the 53,000 versus the equity of the 72,000. So if we calculated that ratio analysis, 53,000 over divided by 72,000, we get to the 73.61% about. But then we changed it so that the debt now is at the 262,878. The equity hasn't changed, right? The equity stayed the same. So that's a substantial difference, substantial change there. The 262,878 divided by the 72,000 gives us about 365.11 there. So we have a substantial difference. So again, some of the ratios, of course, will differ from this. Now there's debate as to how much you need to report and how you need to report this from like a generally accepted accounting principles or financial reporting standard. The idea, of course, of this rule being that if it is a capital lease, we would like to have it included in the balance sheet because it's thought that that would be more transparent. Although if it wasn't in the balance sheet and you still have the rule that the people need, they need to basically report in the footnotes, the lease obligations in the footnotes, then you would think the sophisticated, financial statement analysis person would be taking into consideration the footnotes and would be able to kind of know and understand either way as long as the footnotes were detailed enough to basically take up that information. So there's always debate as to, how exactly you could report this to be the most transparent, and going back and forth between, what should be reported on the balance sheet, the pros and cons versus what should be on the footnotes, and so on and so forth. But you can see the significance of it, and you would think that if something is in substance, what you don't want to have happening, of course, is that people are doing things intentionally to be deceptive, right? If something is in substance a purchase, then why would they set it up as if it was in the form of a lease, right? I mean, it seems like the fact that that could happen seems kind of strange, because you would think that, they would format the transaction in the format that it actually is if there wasn't some other external reason not to. But in any case, there's debates about that, but you can see what the impact would be on the balance sheet here.